Let's kick off last call by breaking down how all of this may balance out for your money after what has been, and let's be honest, a pretty doggone good start to the year or mid-year for stocks. And bringing our friend Tom Lee of Fundstrat in person on this epic hour. Tom, thanks for coming down here as well. You've been one of the bulls. You have been right. Inflation is coming down. The market has been, I think soaring is a pretty good word. We're up 17% year to date. But what have you done for us lately? Where are we going from here, Tom?
Well, Brian, I think that was a great rundown you gave.
There's a lot there.
Yeah, but I think as people peel the onion, this was a very good inflation report because it's setting up for the next 2 months to see inflation slow even further. Because the things that you mentioned, like core services, ex-housing, that came in at 0.22, like 4% year over year, but you're dropping 2 big months of August and September last year. So the next 2 months, that thing's going to start to fall. I think markets should have rallied pretty hard today on the inflation report.
Well, they did. We were up 400 at one point of the Dow. We ended in the green just a touch, but we came down. We lost that 400. Is the Federal Reserve done raising rates, or with today's number, is it, possible we get another rate hike?
Yes. Let's say I was originally in a 60% chance that July was the last hike. I think it's now in the 80% range. I think that the Fed is done hiking for the cycle.
There's a big difference between done hiking and starting cutting. And listen, we're in the media. I fully accept this blame, folks. We're either one all or nothing, right?
Yeah.
Is there any talk of a rate cut at any time soon, or is that just nonsense? And we're going to have to live here for a couple years.
I think rate cuts are definitely coming next year. Let's say that most people think it's second half because the Fed doesn't want to tighten rates, but if inflation's falling, they have to cut rates. Otherwise, it's actually constricting the economy more. I think they're going to be thinking about cuts early next year.
Is that one reason stocks have done well? Not just here, by the way, around the world. Europe has done well, number of emerging markets. But is that the reason that we're seeing a 40% jump on the NASDAQ this year? Is that all you guys, your hedge fund buddies, they're looking out 9 to 12 months, and they're looking out maybe at those cuts and that added, because stocks generally go up when there's more liquidity, not less liquidity.
That's right. And, I think the stock market's just looking at the 10-year at 4 and saying, you know what, a 4% 10-year, even if it's there for 5 years, is actually a decent level for the stock market because it's a high enough rate to keep too much capital from forming, but it's a low enough rate for companies to earn a lot of money. So historically it's nirvana for PE. The PE should be closer to 20 times if we can see the 10-year stay around 4%.
Yeah, I'm old enough to remember when 4% was considered impossibly low.
That's right.
And by the way, that was like 4 years ago.
Yeah.
And now we're doomed at 4. But I think the bears would make the argument, Tom, 4% by itself, not bad. 4% with a $1 trillion plus deficit, heading to $50 trillion in national debt, $1 trillion in consumer credit card debt, $8 trillion in housing debt, that it's the level of debt, not the level of borrowing cost, that's the problem.
That's right. All the things you described threaten the dollar as a reserve currency. The dollar's held up great. I think if the dollar really starts to weaken, then we have to worry that 4% isn't the right rate because they're going to have to raise the rate. But I think for now, the stock markets and bond markets are saying dollar's the currency.
Putting you on the spot, I know. We end the year higher in the S&P 500 than we are right now.
Absolutely. I think we're going to take out all-time highs before the end of the year.